Yes, a very good morning to all of you. Right, so hope all audio, video, all good. Right, so yes, yesterday we started with our discussion on the subject of audit, right, wherein we said that we need to study every topic, every concept from three viewpoints. One from the viewpoint of the MCQ, second from the viewpoint of the correct, incorrect, and third for the theory part of the paper, right, wherein the question and answer theory, right, 4 mark, 5 mark question could be coming over there. Right, and then after that we started with our discussion regarding what is this audit, right? So audit is just a specific word which we use for checking, verification, examination, right? Checking, verification, examination, and the word audit has been derived from the Latin word audere, which means to hear, which means to listen. Right? So ancient times, that is how, medieval times, that is how audit was conducted, and later on, obviously, now there is a revolutionary change regarding how the audit is conducted. So what did we say? Why the audit is conducted? To check the accounts, that purpose is the same. But how the audit is conducted, that has undergone a change over a period of time. Okay, right. And then we said just as to do accounting, there is an accounting software. Similarly, to do audit, there is the auditing software. The person who does the audit is called as the auditor, and the entity where he is doing the audit is called as either the client or could be called as the auditee. Right? So auditor, auditee, or it could be auditor, CA firm, practitioner, CA in practice, and the client, the entity. Right? And in preparation of financial statements in the organization, whose responsibility? It is the responsibility of the management. That management, they will prepare the financial statements. CA, when he will come for the audit, he is going to audit the financial statements. And when an audit of the financial statements is being conducted, that is called as a when CA is coming and doing an audit of the financial statements, that audit is called as a statutory audit. Exactly. That audit is called as a statutory audit. Why? Because it is an audit which is required under the law. And then one, management, they prepare the financial statements. And second, management, they also DIM. You remember DIM? Design, implement, and maintain the internal control system in the organization. Why? In order to PDC. You remember we talked about these terms yesterday? Design, implementation, maintenance, internal control system, prevent or detect and correct any fraud and error. For that, the management is designing, implementing, and maintaining the internal controls in the organization. Right? So again, design, implementation, and maintenance of internal controls in the organization, whose responsibility? It is the responsibility of the management. Right? So if the auditor is doing the audit of these internal control system, then that audit is called as the internal audit. Exactly. Then that audit is called as the internal audit. So we said that mainly there are these two audits. One is the statutory audit, and then there is the internal audit. There are hundreds of other varieties, but these are the two main audits that we are talking about over here. Right? Statutory audit and the internal audit. Right. Then we said just as to do accounting, there is the accounting standards which have been issued by the ICAI. Similarly, to do the audit, the ICAI has issued the standards on auditing, which is one of the branch of the standards on auditing is one of the branch of the wonderful engagement and quality control standards, EQCS. How many EQCS are there? How many engagement and quality control standards? 46 engagement and quality control standards. Okay, engagement and quality control. So quality control, we have one standard, SQC1. And apart from that, for engagement, what are the types of engagement that the CA can perform? Right? What are the types of engagement that the CA can perform? Audit, review, assurance engagement other than audit or review, or other than assurance engagement, he can do the non-assurance engagement, which is also called as the non-assurance engagement, which is also called as the related services. Exactly. Standards on related services. So what are the four types of engagement standards which are there? What are the four types of the engagement standards? Right? Standards on auditing. How many? 38. Then standards on review engagement. How many standards on review engagement? 2. Then standards on assurance engagement, other than audit and review assurance, right? So that is standards on assurance engagement. How many are there? 3 standards on assurance engagement. And then you have the standards on the related services. And how many standards on the related services? We have the 2 standards on the related services. Right, so engagement standards 45 and then 1 standard on the quality control. Right, so I hope you understood this term, engagement and quality control standards. Right, engagement and quality control standards. And basically audit is an assurance engagement. So when you're giving an assurance to someone, what are you doing? We discussed that yesterday. When you're giving an assurance, don't worry, everything will be fine. You're increasing the confidence of the intended users. Exactly. Right? You're giving them a confidence. Why? Because shareholders say, we don't know what the management, how they prepared the financial statements. Then I told you shareholders cannot fill themselves in a truck and then go to the company and check the accounting. So that is why what the shareholders do, they appoint the management, the board of directors to run the company, and they also appoint the auditors. That auditors, you go on behalf of the shareholders, check the work which has been done by the management and give us a report on the same. Like that, whether the financial statements of the company, are they correct or are they not proper, whether the accounting is not proper or so. Okay, right. Then after having our discussion regarding this engagement and quality control standards, we also looked into that we have these 11 chapters in our syllabus. Right, chapter number 1, which was nature, objective and scope of audit, right? The first chapter which we'll study over here. Right, then after that, you know the nature, objective and scope of audit. Now you prepare your audit strategy, your audit plan, your audit programming. That is chapter number 2. Once you've prepared your strategy, plan, program, then you do the risk assessment and internal control. Right? So you understand and verify the internal control system. Once you have done your risk assessment and internal control evaluation, then you do the obtain the audit evidence. And what did we say? What is evidence? Evidence, does it mean proof? No. One synonym for evidence could be, it is information. Exactly, information obtained by the auditor, right? So it is the information. So audit evidence. Then this audit evidence, we also said we have to obtain it for each and every item of the financial statement. So jumbo, big chapter over there, chapter number 5, which is audit of the items of the financial statement. Then it says when you're completing with the audit, there is some completion and review standards to be followed over there. Then whatever work you've done in the audit, you need to document either in the hard file or in the soft file, right? So that is audit documentation, right? Then obviously once you finish your audit, you have to issue the audit report, right? You have to issue the audit report, right? That is up to chapter number 8. Chapter number 9 is the audit of the different types of entities like school, hospital, hotel, cinema hall, educational institution, NGO, charitable institution, trust, society, and so on. Right? Then chapter number 10 is regarding your bank audit, the audit of the banks. And then chapter number 11 is regarding the ethics and the terms of audit engagement. Right? So what we have decided, one, we will discuss chapter number 1, chapter number 11, right? Then discuss chapter number 8. Right? 1 is your nature, objective and scope. 11 is your ethics and terms of the engagement. And then chapter number 8 is regarding the audit report. That is one set. Right? Then the second set which we have is of the audit strategy, risk assessment, audit evidence, completion, review, and so. And then the third set which we have is the audit. An audit of the items of the financial statement, audit of the different types of the entities, and also the audit of the banks. And we said, no, we have these 3 audits. Audits of the items of financial statement, audit of the different types of entities, and the audit of the banks. Right, so first our target is now to complete with chapter number 1, then chapter number 11, and then come to chapter number 8. Okay, right. And then after having our discussion regarding the outline of our syllabus, we came to our discussion regarding the importance of auditing or the importance of the financial statements, or rather importance of audited financial statements. We said no, car and car with the 4 rings, that makes all the difference. Right? So similarly, financial statements useful, but audited financial statements more credible. And what did we say? What is the importance of auditing? Auditing is a, what did we say? It's a gift to the, to whom is it a gift to? It is a gift to the shareholders and to the investors, right? So why it's a gift? Because it is beneficial to the government, then also to the insurance company, then the financial institutions, lenders and the bankers, then also the trade unions, then the shareholders and the investors, right? So this is to who are the users, you know? And then after that, what is the use, right? So what does it say? Government to levy the taxes, and then the insurance company to settle the insurance claim, financial institutions to lend money based on the credit worthiness of the party, right? Then trade unions for settlement of the trade wage negotiations also, right? Then after that, shareholders to come to know regarding the true performance, financial performance of the company, and investors in order to take their investment decisions. And then after looking into the importance of auditing, immediately we did a related topic over there, which was the benefits of auditing, why audit is needed, or also called as the advantages of an audit, right? So in advantages of an audit, again, what did we say? Out of the gift, it is beneficial to the government, it is beneficial to the financial institutions, the banks and the lenders, then also beneficial to the shareholders. And once an audit is done, it provides the reliable information, right? Reliable information. Then what does it say? It will also be able to detect fraud and error. So there is no guarantee that that is not the primary objective of audit, but it may also detect the fraud and error. And that is what we discussed over there. It could also help in detecting the fraud and error, also help in improving the operating effectiveness of the control by identifying the weaknesses, the deficiencies in the internal controls in the organization. Right? So that was another question that we studied, the benefits of audit, or why audit is needed, or the advantages of audit. Right? So these different ways in which this question could be coming in your exams. Okay, right. Then after that, we move further next to the definition of auditing. Do you all remember the definition of auditing? Do you all remember definition of auditing? Did something regarding audit keep on hitting your mind yesterday? Did you read whatever we studied? Did you, prepare the notes? I know you would have done that. I hope I've been effective in conveying it the same to you. Right. So anyways, coming to the definition of auditing. What is that? Audit is an. What is audit? कौन है audit? क्या है audit? Audit is an independent examination. Wonderful. Of who? Of financial information. Of who? Of any entity, whether profit oriented or not, irrespective of its size or legal form. Why doing such an examination when such an examination is being conducted with a view to expressing an opinion thereon? Wonderful. Right? Once again, yes, to give a report. So how do you express your opinion? By issuing an audit report. Right? So what is the definition of audit? Audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, and when such an examination is being conducted with a view to expressing an opinion thereon. Right. So first we said audit is an independent examination. What do you mean by independent? Independent in what? Independent in decision making, independent in judgment. When will you say that whether you are independent in judgment? Exactly. When your decision making is not a subordinate to the wishes or directions of another who might have engaged the auditor or for his own self-interest, right? So not coming under the influence of anybody, right? That is basically what we mean by the independence of the auditor, right? We are going to have a bigger discussion regarding independence of auditor in our chapter number 11 also, right? So independent examination of financial information. Wonderful. You remember that independence of the auditor is non-negotiable. And you can't say little bit, see auditor, little bit here and there, you say nothing. And this is what it is. Okay, right? It is non-negotiable. Okay. Overriding commitment to the independence requirement and not allowing commercial consideration to override your, independence of the auditor. The client is telling you instead of 40 lakh, we give you 80 lakh fee, but you don't, report any fraud error. Auditor will say no. Okay, right. Then after that, we said independent examination of financial information. So financial information is there in the financial statements, and financial statements are prepared from the books of account, right? So what all is included in financial statements? balance sheet, statement of profit and loss, cash flow statement, then the SOCE, statement of changes in equity if applicable, and then the notes. What is notes? What is another name for notes to account? Summary of significant accounting policies and other explanatory information. Right? Summary of significant accounting policies and then the other explanatory information. Right? That is what you mean by the notes to account and the financial statements as a whole. Right? Of any entity. So audit could be done of a profit-making company, not for profit company, 1 crore company, 1,000 crore company. It could be a company, it could be a private company, public company, listed company, foreign company, LLP, association of person, any entity. And irrespective of its size or legal form. So any of it could be the legal form. And why such an examination is being conducted? In order to express an opinion thereon. Right? So ultimately what we have to do, we have to express an opinion on the financial statements. Okay. Right. So now these financial statements, so this is up to where we have already discussed yesterday, right? Right? This is where we have already discussed till yesterday. And then we said, yesterday we studied these two questions, the importance of auditing, the benefits, right? The advantages of the audit. And then we also studied one question which was regarding the definition of auditing, right? So we also had a discussion yesterday, right? So we'll keep making a summary of the chapter also simultaneously, right? So definition of the audit, right? That it's an independent examination of financial information of any entity in order to express an opinion. Right. So auditor, you have to express an opinion on the financial statements. Let me leave a few pages over here. Right. Auditor, you have to express an opinion on the financial statements. Is everybody with me? All good, everyone? Right? Financial statements. Financial statements means what? Balance sheet, statement of profit and loss, cash flow statement, SOCE, right? And the summary of significant accounting policies and the other explanatory information. Now, these financial statements, this yesterday we saw Reliance Industries also, their balance sheet P&L. Obviously, these figures in the financial statements are coming from the schedules. And you have the schedules given in the notes to account, like PP, schedule, debtors, trade payables and other current liability, the breakup given. Then the schedule, these figures are coming from the trial balance. Wonderful. They are coming from the trial balance. In the trial balance, these figures are coming from the, where are they coming? Dropping from the sky? No, wonderful. Very good students. They are coming from the ledger. In the ledgers, they are coming from the they are coming from the, yes, the journal entry. That is your primary books of account, and your journal entries, right? It's coming from the journal, right? And in the journal, it is coming from books of prime entry. Journal, I can also call it as the books of prime entry, or which I can also call it as the books of account. Where is it coming in the books of account from? From where? Is it again dropping from the sky? Or, coming like a, what do you say? Yes, coming from under the surface of the earth. Yes, it's coming from the invoice. It's coming from the source documents. It's coming from the memos and bills. That means, let me call it as, it is coming from the supporting document. And do you know what can you also call a supporting document as? Yes, it is also coming from the, starting with V. You know that word? Yes, exactly. It's coming from the voucher. And a voucher. And a voucher. Okay. Now, so now if these financial statements which are being prepared, are you getting the drill down? Okay, they are prepared on the basis of schedule from the TB from the ledger from the books of prime entry, and books of prime entry to supporting documents and voucher. So ideally, when these financial statements are being prepared by the management, am I right with my sentence? That financial statements are being prepared by the management, because it is the management's responsibility. It is the client's responsibility. Should they agree with the books of account? And do you think that the financial statements, should they be in agreement with the books of account? That in books of account, the revenue of the company is 200 crore. So even in the financial statements, the revenue should be 200 crore. Yes, only then then only it has to be in agreement with the books of account. In reality, many company management, in order to prepare the financial statements, they say we don't require the books of account. You know what is BOA? It is books of account. Ideal situation, what is it? Okay, if company wants to prepare financial statements, it should be prepared on the basis of the underlying books of account. But very, what you say, creative management, they say, no, why are you giving books of account and all? Not required, you keep it with you. Hey, why are you giving all this? You just tell me two things: how much profit you want to show and how much tax you want to pay, and we will prepare the financial statements accordingly. And they say, why you're giving books of account and all? No, not required. We will prepare. You just tell us. Now see, how the management will prepare financial statements. I'm just giving an example. If they want a subsidy from the government, a subsidy, so they have to show that they are a very, a subsidy, please give water. What they have to show, that they are a sick unit, that they are a loss-making company, that they are doing very bad. And on the other hand, the same company management, if they want a loan from the bank, if you want a subsidy from the government, you have to show that you are a sick unit. What did you say? Like that. You have to show that you are a loss-making company. But if you want a loan from the bank, 1,000 crore loan you want from the bank, then you have to show that you are a profit-making company. You understand? No, if anybody is telling you, okay, what are you doing right now? And then you say, oh, if you're not doing anything, then study now. Why are you roaming here and there? So you say, no, today little stomach is paining, little headache is happening, some problem. And then if I tell you, okay, what are you doing today? Come, let's go for a movie. So then you say, oh, yeah, actually, I'm working very hard. I think I deserve to see a movie. You're right, I can do this other work later on. I'll come. My God, what a chameleon. Chameleon? How change of color? The moment you tell study, then stomach is paining. The moment you say movie, okay, all fine, you deserve it. You understand? So now, obviously, there should be no chameleon colors. There have to be the true colors. Whatever is the reality of the company, that should be reflected. If honestly they have a revenue or a profit of 12,000 crore, that should be shown. If honestly they have a loss of 4,000 crore, that should be reflected. You understand now? Honest picture of the financial performance of the company should be reflected. So many company management, they don't require only the books of account to prepare financial statements. They say, just tell us two things: how much profit and tax, we will prepare and give it to you. Obviously, will such books of account or financial statements be considered to be giving the correct picture of the financial performance of the company or the financial status of the company? No. Right? So very, very important. Okay, these financial statements which are being audited by the auditor, and in which auditor is putting a signature saying that we have audited the financial statements and giving the signature, right? These financial statements which have been audited, should they be misleading anybody? Should they mislead in all the gift, to shareholders and investors? Should all of them get misleaded? Should they get misleaded? Should they be misleading the financial statements which have been audited by the CA, by the auditor? No, they should not be misleading anybody. And they should not be misleading anybody. They should be leading, giving the correct picture of the company and not giving the incorrect image about the company. Right? The incorrect image about the company. So as auditor, when I am doing the audit of the financial statements, what I have to check, that these financial statements do not mislead anybody. And how can I check that these financial statements are not misleading anybody? It says S. I tell you how to check whether the financial statements are not misleading anybody. Okay, whatever entries are made in the books of account, the financial statement should be prepared based on the entries in the books of account. So you cannot prepare the financial statements, in your own dream and imaginative world. It says financial statement should be prepared based on the entries in the books of account. Do you agree with point number one? Financial statement should be prepared based on the entries in the books of account. Right. Then these entries which have been made in the books of account should be supported by the sufficient appropriate evidence. तो किधर से लाया? From where did you get this purchase entry, sale entry? Is it a bogus journal entry? Is it a fictitious journal entry? It is just, an entry passed to, increase the sales of the company or under record the expenses of the company. So one financial statement should be prepared based on the entries in the books. These entries in the book should be supported by the underlying documents. Then none of the entries which are there in the book should be omitted. That there are few provisions, liabilities on the company, and these liabilities have not been recorded only. Right, so none of the entries in the books have been omitted, or nothing which is not there in the books has found its place in the financial statements. Okay, there is no other income of the company, but unnecessarily you're saying in the financial statements that there is 20 crore other income of the company. Right, so none of the entries, what is there in the books, should not be omitted to be given in the financial statements, and what is not there in the books, that should not be included in the financial statements. So what is there in the books? You have some liabilities to pay. These liabilities, have you recorded in financial statements? No. Or in the books of account, there is no other income of the company. But in the financial statements, you've shown the 20 crore other income of the company. Right? So, just a moment. Right. So everything which is there in the financial statements, it should, in the books of account, it should not be omitted in the financial statements, and nothing which is not there in the books of account should be included in the financial statements. Do you understand point number 1, 2, and 3? Right, so what is point number 1, 2, and 3? I said that these financial statements should not be misleading anybody. And what is point number 1? The accounts, that is the financial statements, have been drawn with reference to the entries in the books. Entries in the books are supported by the sufficient appropriate evidence. I'll come to the term sufficient appropriate evidence shortly. Then none of the entries in the book should be omitted in the process of the compilation. Right? So not that few provisions, few liabilities were not recorded. No. Right? So that is entry, entry, entry. Are you understanding that? One account should be prepared on the basis of entry. Entry should be supported by documents, supportings, and then none of the entries should be omitted. Right, that is EEE. And then after that you have the SSS. Whatever information is conveyed by the statements, financial statements, it is clear and unambiguous. What is unambiguous? Which is not, what do you say, jelly? It's like opaque, no? You can't translucent. It's not like transparent. It's like an ambiguous liquid. So I read the financial statements of the company, but I'm not able to understand that whether this is really a sales transaction or not a sales transaction. It's very ambiguous. Should it be ambiguous? You're not getting a clear picture. It's like, sometimes on your mobile phone camera, if there is some smudge over here, can you click a clear picture? No. It does a smudge effect comes over there. So how the financial statement should be there? They should be clear and unambiguous. Ambiguous means they are not clear. So unambiguous is nothing but they should be clear. Right? So clear and unambiguous. Right? They have to be clear and unambiguous. That is point number 4. Point number 5, the financial statement amounts. So whatever amounts are shown in the financial statement, debtor, creditor, inventory, cash in bank, it says are properly classified, described, disclosed in conformity with the accounting standards. Accounting standards, we said we can also call it as the generally accepted accounting principles. Right? So financial statement amounts are properly classified. So should not happen that it's a long-term loan, but it has been shown as a short-term loan. And it should be properly classified, described. It should not happen that it's actually a liability deposit of a loan given by the company, but it is being shown as a deposit. No, so it should be properly described and disclosed in conformity with the accounting standards. And ultimately, the most important point over there, right? So what is one? Information conveyed in the statement is clear and unambiguous. Then financial statement amounts are properly classified, described, disclosed in accordance with the accounting standards. And the statement of accounts. So do you see the SSS over there? What is the first S over there? Financial statements are clear and unambiguous. Second, what does it say? All the amounts which are shown in the financial statements are properly classified, described, disclosed in accordance with the accounting standards. And then it says the statement, right? The financial statement, right? The statement of accounts, right? That is your balance sheet, presents a true and fair picture. Right? Statement of accounts present a true and fair picture of the operational results and of the assets and liabilities. Right. So, what did we say in the definition of audit? Auditor, you have to express an opinion. Like I told you yesterday, you taste the food and then after that you have to express an opinion on the food. So what words do you use if you come to know that the food is very nice? What words do you use? And you had the food, you tasted, and it was very nice. So what could you use? Different words to say that? Yes, yummy, delicious, okay, fabulous, okay, and mind-blowing. You could be using these words. So do you need some words to express an opinion? Do you need some, words in your dictionary, some vocabulary in order to express an opinion? Similarly, now I have done the audit of the financial statements. Now I have to express an opinion on these financial statements. I've checked them. I verified them. I audited them. Now I have to express an opinion. And now obviously to express an opinion, do I need a phrase? Like yummy, tasty, delicious. So can I say yummy financial statements, delicious financial statements? No. Here what we say is that the financial statement, we express an opinion whether or not they give a true and fair view. And that is the phrase used by the auditor. And you will need some words now to express your view. So what words do you need to express your view is true and fair view. True and fair view of what? View of the, what you say, the Alps or the Himalayas, or what? True and fair view of the state of affairs. State of affairs of what reflects the state of affairs of the company? It says true and fair view of the state of affairs of the results, right? Also called as the profit or loss of the entity, the cash flows of the entity for the period ended on that date. So obviously state of affairs is reflected by the balance sheet. Results, profit and loss is reflected by the profit and loss account. And cash flows, it is reflected by the cash flow statement. And a true and fair view. Right? So if I take you Reliance Industries ka audit report, which we were seeing yesterday, let us just read the opinion paragraph. Anyways, we'll come to that in detail, but just for us to make sense of what we are talking about over here. Do you see this opinion paragraph? Yesterday we'd seen, no, it is independent auditor's report. You remember that? Not only auditor, independent auditor's report. And look at the fellow, auditor. I'll come to the entire content, but right now just bringing you to the relevant point. In our opinion, means whose opinion? Auditor uncle. It is the opinion of the auditor. What does it say? In our opinion, mere opinion mein. And to the best of our information and according to the explanation given to us, the aforesaid standalone. And there are two types of financial statements. One is the standalone financial statements and second is the consolidated financial statements. Can anybody guess what would this mean? Standalone and consolidated. SCFS, wonderful. Right? So standalone and the consolidated financial statements. What do you may think? Right, so can one, something called a subsidiary, associate, joint venture? Everybody pay attention, sit straight. Do you know something called a subsidiary, associate, joint venture? Right, so obviously there is a parent company. And a parent company also called as the holding company. And this holding company also has a lot of subsidiaries, not less than 51% of the equity share capital or the decision making stake. Right? Then they have the associates and also the joint ventures, joint operations and so. Right? So only if parent company, only if holding company, like say Tata Motors is the parent company. Example I'm giving you, say Tata Motors has 20 subsidiaries. Example. Let's say example it has 20 subsidiaries. Right. So only if Tata Motors financial statements are being prepared, that is called as standalone, only of the parent company. And parent company plus the subsidiary, associate, joint venture put together. Okay, parent company plus the 20 subsidiaries and the 2 associates and the 3 joint venture, all that put together when the financial statements are being prepared, that is consolidated financial statements. And a consolidated group financial statements, this is individual. Okay, please don't confuse that with branches. And branch ka information will be included in parent company. And so if Tata Motors is having, example, 40 branches, if Tata Motors example is having the 40 branches, this 40 branches ka information is included in the standalone itself. But Tata Motors is having the 20 subsidiaries, example. So now this standalone plus the 20 subsidiary put together, that will make it as the consolidated financial statements. Like, let's have a better understanding. You look over here, I'll come to that term again. But these are the standalone financial statements of Reliance Industries. And if you see the balance sheet and the profit and loss yesterday, right, this was all for the standalone. Right, so stand alone, only Reliance Industries, how much is their revenue? 541,791 crore. Only parent company, only of Reliance Industries individually. And obviously along with its branches, but only of the parent company it is 5,41,791 crore. But if I finish with the standalone financial statements, after the standalone financial statements, you will see over there something called as the consolidated financial statements, right? Just let me move on over there. Right, the consolidated financial statements. You see audit report also, consolidated independent auditors report. And now over here, if I come to the balance sheet and then to the profit and loss account, now it says consolidated statement of profit and loss. And now how much is their revenue? 891,311 crore. Wahan kitna tha? Some 5 lakh crore. And here with all their subsidiary, associate, joint venture put together, Reliance ke group ka, how much is the revenue that they have over there? 8 lakh crore. You understand everyone? Standalone financial statements, parent company has to prepare financial statements, standalone also and consolidated also. Yes, both is responsibility of the parent company. You understand everyone this term? Standalone financial statements, consolidated financial statements. You understand? Okay, right. So anyways, let's go back to our opinion paragraph in the standalone financial statements ka audit report. Okay. Right. So we are over here. In our opinion, and to the best of our information and according to the explanation given to us, the aforesaid standalone financial statements, one, they give the information required by the Companies Act. So one, the financial statement should give the information required by the Companies Act in the manner so required. And second, they give. So 2 gives are there. What are the 2 gives over there? One, the financial statements give the information required by the Act in the manner so required. And second, the financial statements give a true and fair view. And they give a true and fair view. True and fair view in conformity with the Indian accounting standards prescribed under section 133 of the Act, read with Company Ind AS Rules 2015 and other 2015 and other accounting principles, that is GAAP of generally accepted in India, of the, everybody please read, of the state of affairs. Who shows the state of affairs of the company? Where will I come to know the state of affairs of the company? By looking at the balance sheet. Every day can I prepare a balance sheet? Because balance sheet is as at 31st March 2025. So balance sheet is as at. Every day you can prepare the asset liability position. But profit and loss account is for the year ended. That means it's for a particular period. How much is the revenue and the purchases of the company or so. So state of affairs, that is balance sheet of the company as at 31st March 23. It's profit. Its profit means it's the profit and loss account. Total comprehensive income, again there in the profit and loss account. It's cash flows. Cash flows are there in the cash flow statement, and the changes in equity for the year ended on that date. That is nothing but your SOCE. Right? So when we say true and fair view of the financial statement, actually, technically, more correctly, you can call it as true and fair view of the state of affairs, the results. Result could be either profit result or loss result. Right? It could either be profit or loss. So true and fair view of the state of affairs, the results, the cash flows, and the changes in equity for the year ended on that date. Right? So this is the bread and butter. You understand? This is the earning for the CA. What is the earning for the CA? To express an opinion on the true and fair view. What are you paid your audit fees for? For expressing this opinion on the true and fair view. True and fair view of the, yes, tell me everyone, state of affairs, the results. Results could be profit or it could be loss, and the other comprehensive income, right? Then the cash flows and the changes in the equity for the year ended on that date, right? Changes in the equity for the year ended on that date. Right, so now, once upon a time, and right now, today, if I like Reliance Industries, I showed you the 2023 report. Today, if you have to express an opinion on the financial statements, what phrase do you use for expressing your opinion? What phrase do you use for expressing your opinion today? True and fair view. And there are two alternative terms which are used for true and fair. Either you say they give a true and fair view, or you can say present fairly. The standard has given two options, but you know what is very, very popular is the true and fair. Though there are two ways, you can say they present fairly, the state of affairs, or you say true and fair. But like true and fair is very, very popular. And nobody uses the other name that is present fairly, like like Bangalore has now been also renamed, has now been renamed to be called as Bengaluru. So they, though you can use Bengaluru, but even you still continue to use Bangalore. You understand? No, so this is like Bangalore and this is like Bengaluru, so it means one and the same thing, but what is more popular is referring to it as Bangalore. That is the true and fair view. And so today, and today when we have to express an opinion, current scenario, what opinion do we express? True and fair view. But ancient times, olden times, when the concept of auditing had just begun, that time, earlier, once upon a time in history, that time the auditor used to express an opinion saying the financial statements are true and correct. And now this true and correct has been replaced by true and fair. Now it has been replaced by true and fair. True and correct. Out of what I have discussed with you yesterday, can anybody give me the relevant terms when I say true and fair and true and correct? Ma'am, if you're saying true and fair, that means it's a, and ma'am, if you say true and correct, that means it's like a, you have to fill in all the blanks. Exactly, exactly. Wonderful job. If I say true and fair, that means I'm giving a 99.99. Do you remember that all? Yes, exactly. You're giving a reasonable assurance. But here when you're saying true and correct, correct to correct. No. There is nothing incorrect over there. So here it was the absolute assurance. So originally when audit started, it was the primary objective also to detect fraud and error. But today what did we say? That is not primary objective. Today primary objective is to obtain the reasonable assurance. And earlier, originally, when we used to do the audit, that time our focus used to only be on the mathematical accuracy or the arithmetical accuracy of the books of account. And mathematical accuracy, that is what our focus used to be. Like, cost of the asset 1 lakh, say example, cost of the asset 1 lakh, depreciation 40%, and then whether the amount is 40,000. That's it. And then you say, yeah, 1 lakh into 40%, 40,000, true and correct. We wouldn't used to bother. Now, today, do I check this mathematical calculation? 100% yes. I will check the mathematical accuracy. But I won't stop just with checking the mathematical accuracy. Today, I will check whether this cost of asset of 1 lakh is it proper, or whether there is some incidental expense which should be added to the cost of asset and cost only should be 1,20,000. Then I'll say, from where or not did you get the rate of depreciation to be 40%? Your rate of depreciation should be 25%. And then I will also check the calculation. So earlier what I used to do, I wouldn't used to bother from where this 1 lakh come, why they took this 40%, nothing. Simple mathematical accuracy. 2 plus 2, check 40,000. You say, yeah, correct calculation, true and correct. True and correct. Today, what we do we check this mathematical calculations also? Yes. But in addition, what we also check? The cost of the asset. We also check the rate of depreciation. We also check the compliance with the Ind AS 16. We also check the compliance with the Schedule 3 requirement. And we also check the calculations. And after checking all this, now today we express an opinion saying true and fair. Do you understand what I say, everyone? Pay attention, each one of you. Nobody else can pay attention on your behalf. You have to do the job for yourself. You understand, no, what I say? Someday I come to know you're not understanding, I might pop out of the screen to, just make you alert again, right, while attending the class. They'll say, ma'am, don't worry. As if we are anyways, not feeling like, geographical distance over there. We are very much able to attend the class very powerfully. No, there is artificial intelligence and all these new technologies, metaverse and all coming. So you never know if that could also happen. Okay, right. So anyways, listen to me. Pay attention. Okay, you understand true and fair view. So this is one of the golden term in the audit. Okay, auditor, you have to express an opinion. What phrase will you use to express an opinion? True and fair view. And to express an opinion on the true and fair view of the state of affairs, results, cash flow, and the changes in equity for the year ended on that date. So, auditor, when you are doing the audit of the financial statements, you have to check that these financial statements are not misleading anybody. They should not mislead. So, what do you say? SS, I will check that they are not misleading anybody. Why you're doing so much SS that they are not misleading anybody? Why? Because we have 3 points of E and 3 points of the S. Right? What are the 3 points of the E? One, the accounts have been drawn with reference to the entries. Then entries are supported by the evidence, supported by the documents. Then after that, none of the entries have been omitted. So entry. Then financial statement amount, statement. So financial statement amount is clear and unambiguous. Then again, the financial statement amounts are properly classified, described, disclosed in conformity with the accounting standard. And the statement of account show a true and fair picture or true and fair view of the operational results. Operational results means profit and loss account, and assets and liabilities means the balance sheet. Right? It means the balance sheet. Right, so that covers our discussion regarding the definition of the auditing. Right, so what we have to check that the financial statements are not misleading anybody. And for them not to be misleading anybody, what you need to check for? Entry, statement. Entry, and then you also need to check for the statement and the statement. Right, clear everyone, the definition of the auditing? Yes, everyone, all good with the definition of auditing? Okay, I'm still left with the discussion regarding the origin of auditing and the relationship of auditing with other disciplines. I'll come to that. Little bit will change the sequence. Right, so auditing provides assurance. We said now audit is a type of an assurance engagement. And when you give an assurance, what are you doing? Providing confidence to the users that financial information reflected in the financial statements can be relied upon. Hey, does this make sense to us? Few hours into study of the subject of audit, and then can we understand its basic nature? Audit basic nature lies in providing assurance to the users, providing confidence to the users. Such an assurance lends credibility to financial statements. Audited financial statements provide confidence to the users that financial information reflected in financial statements can be relied upon. You understand what has been discussed over here? Wonderful. So that covers our discussion regarding the definition of the audit. Now let us talk about the objective of audit, and then after that the scope of audit. Right, so now our next discussion point number 4 is regarding the objective of audit, and then after that we discuss what is included in the scope of audit and what is not included in the scope of audit. Okay, right, so now let's talk about the objective of the audit. And when I have to discuss with you, you understand objective? Objective? Yes, give me words for understanding objective. It's your aim, goal, purpose, your target, which is to be achieved, and something that needs to be achieved. No, it can't be advantage, but it's the objective. And okay, what purpose are you doing? You say you're every day doing some push-ups and all of that. So what is your objective behind that? That you want to develop your, what you say, your muscle strength over there. Right? So there is an objective behind the same. So now when auditor is doing the audit of the financial statements, obviously he has an objective. Can you guess what would be the objective? I've already told you. What is the why you do audit? Why you are checking financial statements in order to wonderful to express an opinion. What phrase will you use to express your opinion? To give report. Obviously, I can express my opinion by issuing a report. And what phrase will I use? True and fair view. Wonderful. Right. So with that in the background, let's now get into the technical discussion of the objective of the audit. Right. So again, chapter number 1, because it's the introduction to the subject, right? Very important chapter. Right. So now this objective of audit, what happens? They give some general theory discussion. Like, they have discussed the definition of auditing, importance of auditing, benefits of auditing, and somewhere in between they also incorporate the discussions from the standards. What do you think? Which standards would I be talking about right now? Yes, 100% I'm talking about the standards on auditing. I'm talking about the standards on auditing, right? And in these standards on auditing, we have first standard over there, which is SA 200. Which is SA 200. Right. And what is the title? You understand title? Like every movie has a title. Audit report also has a title. Independent audit report. So every essay also has a title. It has a name. So what is the name or the title of SA 200? Overall objective. So they say it's not only the objective, it is the overall objectives of the dash auditor. Can anybody guess which auditor? Yes, 100%. Overall objectives of the independent auditor. So they say we will tell you what is your objective of doing the audit. And then once I know, okay, oh, this is the reason why I'm doing the audit, then can I do the audit as I wish? Can I just say, okay, I know the objective. Now don't worry, I will do it as I wish. No. How I have to do the audit? कैसे करे? कसं करायचं ऑडिट मग? Can करनो? How to do the audit now? Exactly. And the conduct of an auditor, the conduct of an auditor in accordance with the standards on auditing. And in accordance with the standards on auditing. That is the overall objectives of the independent auditor and the conduct of an audit in accordance with the standards on auditing. That is the title of SA 200. Do you understand the title of SA 200? What is the title? Overall objectives. What does it say? What does it say? Overall objectives. Overall objectives. Overall objectives. O. How many O's? How many O's? 2. So SA 200. SA 200. What is 200? It is overall objectives of the independent auditor and the conduct of an audit in accordance with the standards on auditing. You say, no, now I know what is the objective. Don't worry, I'll do it. No, don't worry, what? Come here. You have to do the audit in accordance with the standards on auditing. Title of SA 200, clear to everyone? Title of SA 200, clear to everyone? Yes, overall objectives of the independent auditor and the conduct of an audit in accordance with the standards on auditing. So now let's try to understand from SA 200 what is the overall objectives of the independent auditor. The overall objectives of the independent auditor. Right. So obviously, right, now we have to study, okay, auditor, you're doing the audit, what you want to achieve? And what you want to achieve by doing the audit? What is your objective? What is your goal? What is your target? So CA says, auditor says, I want to obtain. To obtain. What do you think? What he wants to obtain? To get, to obtain, to procure, to receive, to get what? To obtain 99.99? Exactly. To obtain the reasonable assurance. Reasonable. And what to obtain? I will do the audit of the financial statements, and what I want to obtain is a reasonable assurance. What reasonable assurance? किस चीज के लिए? For what do you want? Like Dettol, it gives 99.99% assurance regarding what? 99.99% germs will be taken care of. Right? So similarly over here, auditor, what reasonable assurance you want to obtain? The financial statements which are being audited by the auditor are free from material misstatement. Oh my God, what rock solid terms are we going to discuss today? Free from material misstatement, whether due to fraud or whether due to error. Part 1 of the overall objective, to obtain reasonable assurance. What? That the financial statements which are being audited by the auditor are free from material misstatement, whether due to fraud or error. Thereby, so once you get this reasonable assurance, now what you can do? Thereby enabling the auditor to express an opinion. Express an opinion what? That the financial statements, whose responsibility to prepare financial statements? Management. That financial statements have been prepared by the management in accordance with an applicable financial reporting framework. An applicable financial reporting framework. And then in order to express that opinion, what auditor you need to do? You need to issue a report. Right? To issue a report. Why to issue the report? To communicate his findings. And how do you communicate your finding? As you wish? No. Again, you have to communicate your findings in accordance with the standards on auditing. And there's a format of the audit report given in SA 700, forming an opinion and reporting on financial statements. So that format of the audit report we will have to follow. This is the overall objective of the independent auditor. So now, for us to understand, make sense of this overall objective of the independent auditor, we need to understand three terms. One, reasonable assurance. Second most important rocking term of SA 200, free from material misstatement, whether due to fraud or error. And third important term over there is applicable financial reporting framework. I think once we understand these three terms, we are in a better position to get an understanding of this overall objective of the auditor, of the independent auditor. Right, so to obtain reasonable assurance. So first let's take this first term over there, which is reasonable assurance. Are you all with me? You understand what I have written right now over here is the overall objective. Now we will try to understand these three terms. Once we understand, then we will again try to get an overall view of the overall objective of the auditor. Right. So first point over there, it says objective of the auditor is to obtain a reasonable assurance. What is reasonable assurance? It is the high level of assurance, 99, 95, 93, 94, whatever. It's the professional judgment of the auditor. It is a high level of assurance, but it is not an, it is a high level of assurance, but not an absolute assurance. Is reasonable assurance 100% assurance? No. Is it a high level of assurance? Yes. Why CA? What is the problem with you? Why you're giving only reasonable assurance? Why can't you just quietly give us the absolute assurance? Why CA you are giving us the reasonable assurance and why you cannot give us the absolute assurance? Because one, I told you, okay, the evidence obtained by the auditor is persuasive. You remember persuasive, most likely to be true than not. And it is not the conclusive evidence. Had we got the conclusive evidence, we would have given the absolute assurance. But because we are getting the persuasive evidence, that is, we are giving the reasonable assurance. So that is reasonable assurance, but not absolute assurance. And what do you say? Reasonable assurance is a high level of assurance, but it is not an absolute assurance. Why? One reason is that the evidence obtained is persuasive, conclusive. So my other question is, what is the problem? Why you can't obtain conclusive evidence? See, what we say, if I get conclusive evidence, I will be able to give the absolute assurance. Then no problem, go ahead. Go ahead and obtain the conclusive evidence. Then you can give absolute assurance. But you say, nahi ma'am, nahi milta hai. You don't get. It's not possible to get conclusive evidence. Why it is not possible? It is not possible to obtain conclusive evidence. Exactly, because audit is not an investigation, because we have to rely on management for evidences, because it's not an investigation. So basically, what are you telling me over here? Okay, why it is not possible to get conclusive evidence? Because of the inherent limitations of an audit. Right, so very important rocking question again, which we need to discuss over here is the inherent limitations of an audit. Inherent means what? By default. You can't do anything about it. It's going to be there by default. Like, if I tell you, visualize. What you visualize? Okay, there is a big gate and some particular fort or something, it has a big gate, and inside that big gate, there is an elephant entering inside. Can you imagine that? Elephant, grey color. If you go to Guru Ayur in Kerala, my God, what amazing elephants, like, the most healthiest ones ever seen. Okay, so now that elephant is entering into the fort, into the gates of the fort. Right, so now there is a fort, big gate over there, and now you see that the elephant is entering over there. So now, if I'm telling you, see, the elephant is entering the fort, like, do I need to separately tell you, along with the elephant, the tail of the elephant is also entering the fort? You'll say, ma'am, it's assumed, na? If the elephant is entering, then his trunk will enter, his ears will enter, his entire fort, his legs will enter, his tail will enter. No need to tell it separately. But see, the elephant is entering into the fort along with its tail. As you say, ma'am, it's assumed. If it can't leave its tail somewhere and then enter the fort. You understand? So like that, this is inherent limitation. That means whenever you do an audit, these limitations are always going to be there. You'll say, ma'am, no, I want to avoid them. Not possible. It is always going to be there. Whenever you do an audit, these limitations are always going to be there. That is why they are called as the inherent limitations of an audit. It is there by default. You can try to reduce them, but can you make it zero? No. They are there by default. Inherent limitations of an audit. Inherent limitation. You understand? Every time you drive a bike, every time there is a possibility that you might meet with an accident. But say you may never meet with an accident, but every time is that possibility there? Yes. Right? So it is there by default. It is an inherent limitation. And what are the inherent limitations? I'll come to that. But because of these inherent limitations, auditor says, I can only give you the reasonable assurance, absolute assurance, not possible. And a reasonable assurance, which is a high level of assurance, but not an absolute assurance. Okay. And reasonable assurance regarding what? Auditor says I can obtain only and I can give only by expressing my opinion only the reasonable assurance. Now this thing would say, what are you going to give the reasonable assurance regarding? He says, I will give reasonable assurance. Give these financial statements. You understand financial statements? Balance sheet, profit and loss, cash flow, notes, SOCE. That these financial statements are free from material misstatement, whether due to fraud or whether due to error. Everybody, are you listening to what I say? And a free, reasonable assurance that financial statements are free from a material misstatement, whether due to fraud or error. Let's try to analyze this term one by one. Right, first let's try to understand the term misstatement. Okay, this is not a statement, this is the misstatement. Means what? You'll say, ma'am, this is not a statement, this is the misstatement. When would you say that? What do you mean by misstatement? Wrong statement, wonderful, which is not correct, okay. Yes. Incorrect statement, okay. In the context of financial statements, can you give me an example of a misstatement? Now, amounts in the financial statements are wrong, very good. Disclosures in the financial statements are wrong, very good. Sales overvalue, wonderful. Value of inventory, over or undervaluation of inventory, it's a misstatement. Say actual it's misleading, very good. And actual value of the inventory of the company is say 180 crore. Actually, really, truly, the value of the inventory of the company is how much? 20 crore. 180 crore. And now, how much have they shown it in the books of account to be? 200 crore. Right? How much have they shown it in the books of account to be? 200 crore. You understand? So what is the actual value of the inventory? 180 crore. And how much have they shown it as? 200 crore. And they've inflated. They can also deflate. And they can overvalue or undervalue. Here we are just taking one example where they've done the overvaluation of the inventory. Right. So now, basically, if I have to make a definition of the term misstatement, what I can say, what is the misstatement? It is the difference between what is 200 crore and what should be. In my example, what should be is how much? 180 crore. So the difference between these two, 20 crore, is a misstatement. The difference between these two, 20 crore, is a misstatement. What is contingent liabilities not disclosed? What should be? Contingent liability should have been disclosed. What is provision not made? What should be? Provision should be made. Right? So everywhere where there is a difference between what is and what should be, that is the misstatement. And this difference between what is and what should be, it could be intentional or it could be unintentional. If it is intentional, it is a fraud. Deliberately you did the wrong valuation of inventory, overvaluation of inventory, it's a fraud. By mistake you did the wrong valuation of inventory, then it's an error. And then it becomes an error. Are you understanding that? Okay. So we understand the first part of the term, okay, misstatement. It is the difference between what is and what should be. Now, here we come across another important term, which is material misstatement. And material, right? When we talk about AS1 or the Ind AS1, right, we have some fundamental accounting considerations over there. Do you know those? The fundamental accounting considerations. Do you know those? Yes, prudence, right? Then the substance over form, right? Prudence, substance over form, and then the materiality. You understand? These are the accounting considerations when the accounting policies are being selected. And then what are the fundamental accounting assumptions? What are the fundamental accounting assumptions which are there? Yes, fundamental accounting assumptions, very good. Going concern, yes, going concern, right? Then after that, the accrual basis of the accounting, right? Going concern, accrual basis, and also the fundamental, right? The double entry system of accounting or so. Right? So going concern, right? Accrual basis. Now, what is one of the accounting consideration that we have over there is of the materiality. And materiality, right? So what is materiality? Whenever you select an accounting policy, one, it says you should go by the concept of prudence. What is the concept of prudence? Ke anticipated incomes and gains should be ignored, and anticipated losses and expenses should be provided for. That is, you should have the conservative approach, right? Then substance over form. Like if there is a pen drive, and in the pen drive, the pen drive is of 350 rupees, but there is a software of 200 crore rupees in that pen drive. Will you show it as stationery or will you show it as an intangible asset? Right? So obviously you have to show it as an intangible asset, right? So that is the concept of the substance over form. And then it says you also need to apply the concept of the materiality, right? So what is this concept of the materiality over here? It's this materiality, material, right? Material over here. Now generally we say raw material, or we say the material of a particular fabric or so, but here the materiality we are talking about any item or any information which might influence the decision making of the users of the financial statement, which might influence the decision making of the users of the financial statements. Who are the users? We said it's a gift to the shareholders and investors and stakeholders of the company. So like, any, like say there is the contingent liability. I hope you understand the term contingent liability. Some litigation, then some legal matter going on against the company, say of 200 crore. Now this contingent liability ideally should have been disclosed in the notes to account because it's a contingent. It's not yet sure. So no provision to be made. But this has not been disclosed in the notes to account. Okay, now say the user of the financial statement had this material information being given over there, they would have never invested in the shares of the company. That means it is affecting their decision making. Right? Or but say there is a contingent liability of 20 lakh which has not been disclosed in the books of account. It says this may not affect the decision making of the users. And this will not affect the decision making of the users, right? So here we are talking about what is materiality. It is any item or any information in the financial statements which might influence the decision making of the users of the financial statement. Okay, one 10 rupee expense has not been properly recorded. It won't affect the decision making of the users. But one 10 crore ka royalty expenditure is not properly recorded. Yeah, it will affect the decision making of the users of the financial statements. How to determine materiality? When I have to do audit, obviously you have to determine, you have to calculate the materiality. So that we have a separate standard SA 320. And I told you we have the 38 standards. So one of them is SA 320, which is regarding the materiality in planning and performing an audit. And a plan materiality in planning and performing an audit. So where we discuss more about the materiality. But now anyways, coming to this material misstatement, right? So now, right, so see how to determine materiality. I told you I'll discuss with you in SA 320. But right now, example, say auditor. Say auditor has decided that materiality is 10 crore. How to calculate this amount? Every company, every entity, I'll tell you. Right now, randomly, I've taken it to be 10 crore. Okay, so now say materiality is 10 crore. Okay, now what is the difference over here in the value of inventory between what is and what should be? 20 crore. Is it a material misstatement? Is it a material difference between what is and what should be? Yes, because materiality is how much? It is 10 crore. And how much is the difference? 20 crore. So is it going to affect the decision making of the users? Yes. See, on the other hand, materiality was 50 crore. Then you say ignore. And like Reliance Industry, 5 lakh crore is their revenue. 10 crore, 20 crore error, not material over there. You find out 10 crore, 20 crore error, nobody will look at you also. But because look at the size of the organization of 5 lakh crore. But if I'm doing the audit of a 50 crore company, then maybe a 20 lakh transaction could also be material. Right. So anyways, material misstatement is material difference between what is and what should be. And now we have the third word over there, free from material misstatement. Can anybody tell me now what I should write? What is misstatement? Difference between what is and what should be. What is material misstatement? Material difference between what is and what should be. What is free from material misstatement? free. That means there is, yes, that means there is, wonderful, no material difference between what is and what should be. No material difference. That means there is, in more simple words, what is misstatement? Fraud or error. What is material misstatement? Material fraud and error. And a misstatement is fraud and error. So ultimately what we can say, free from material misstatement is nothing but the auditor is saying, I have obtained a reasonable assurance that there is no material fraud or error in these financial statements. There is no material fraud or error. Because let's look at it the other way around. You understand? No material fraud and error. That is free from material misstatement. No material difference between what is and what should be. Because as an auditor, what is our objective? To express an opinion on the, we say that term, no? What is the term? To express an opinion on the true and fair view. You tell me logically कि if there is a material fraud, and a material which is affecting the decision making of the users, if there is a material error in the financial statements, can such financial statements give a true and fair view? Can you say, yeah, there is material fraud, there is material error, but no problem, they are giving true and fair view? Is this possible? कि बड़े fraud है, बड़े error है. No, you are taking a diabetes medicine, you are taking a BP medicine, you are taking some another medicine, and then you think, absolutely fit and fine, say nothing is happening to me. Look at you, yeah, so many problems you have. How you can say there is no problem? You understand? No. So material fraud and error, then can you say true and fair? No. So for auditor to express an opinion saying true and fair, the financial statements have to be free from material misstatement. Free from material misstatement. Free from material fraud and error. Immaterial, okay. No problem. But material fraud and error, nahi, then how we can say true and fair? You understand? No. Material fraud and error, then can we say true and fair? Simple question. If there is material fraud, material error in the financial statements, can you express an opinion saying true and fair? No. So for auditor to express an opinion saying true and fair, financial statement should be free from material fraud and error. There should be no material fraud or error. 100,000%, please all of you check with your own self. Have you understood this term? Free from material misstatement. Because if you don't know this, you don't understand the further concepts. And this is one of the important terminology in audit. So when I write it in class, I write MT and MS. So exams, you won't write the full word. But yeah, what is MT? It is material. And what is MS? It is the misstatement. Free from material fraud or error. No material fraud or error. You understand this term? Any questions, anyone? Anyone? Any questions? Understood? Okay. Now you've got that assurance. Ki yeah, the financial statements are free from material misstatement. It says now auditor proceed ahead. Now what you can do, express an opinion saying what? That management, obviously preparation of financial statements, whose responsibility? Management's responsibility. That management has prepared the financial statements in accordance with that. Oh my God, next wonderful term over there, applicable financial reporting framework. And applicable financial reporting framework, AFRF. AFRF. Another mind-boggling, super important term in audit. Applicable financial reporting framework. Yes, do you know how to convert an active voice into passive voice? If I say my favorite subject is audit, and then if I have to say it the reverse way, I'll say audit is my favorite subject. You understand? My favorite subject is audit and audit is my favorite subject. Okay. So likewise, if I have to convert this applicable financial reporting framework instead of left to right, if I have to read it right to left, can anybody do that for me? Don't say framework reporting financial applicable. What you are doing must be. If I say applicable financial reporting framework, read to right to left, they read framework reporting financial applicable. No. Yeah, the reporting framework applicable to financial statements. Okay. Anything else? Anybody? Karo, where you got Karo re? No, 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 no. Wrong application of knowledge. That is company's auditor's report order. We'll come to that later. Applicant, the financial reporting framework applicable. Okay, applicable framework for financial reporting. Okay. Use maybe some better answer. Applicable financial reporting framework. Okay. Other words, I could call it as it is the framework which is to be applied while doing the financial reporting. It is the framework and a framework. This is the framework. You can't do the accounting as you wish. This framework you have to apply when you're doing the financial reporting. What is financial reporting? What is financial reporting? You'll say, ma'am, CA final group 1 accounts. That is financial reporting. So, once you do accounting, then you can prepare financial statements. That's your financial reporting. So, ultimately, financial reporting is nothing but your accounting. Financial reporting is nothing but your accounting. So what I can say, applicable financial reporting framework is the framework which is to be applied. Who is going to apply this framework? Whatever is the framework, who is going to apply it? Obviously the management. When they are doing the accounting, when they are doing financial reporting, exactly. That means when they are preparing the financial statements. Right. So it is the framework which is to be applied. By whom? Applied by the management. When to be applied by management? When it is preparing the financial statements, in the preparation of financial statements. Okay. Now what do you mean by a framework? कि तुम्हें एक boundary दिया हुआ है कि this is what you need to follow when the financials are to apply, when the financial statements are being prepared. So framework is nothing but the laws and regulations. The laws and regulations which are to be applied by the management in the preparation of financial statements. That is applicable financial reporting framework. Example, you understand, it is the framework, that is the laws and regulations which are to be applied by the management in the when they are preparing the financial statements. They can't prepare financial statements as they wish. They have to prepare it as per the laws and regulations. That is the framework, right, which is applied by the management in the preparation of the financial statements. Example, an Indian company, when the management of an Indian company wants to prepare its financial statements, has to prepare its financial statements, what AFRF will they use? What laws and regulations will they apply in preparing the financial statements? They will follow, wonderful, superb students. They will follow the Ind AS and the Schedule 3 to the Companies Act, which gives the format of the presentation structure of the financial statements. Now, so Ind AS and Schedule 3 is an example of an AFRF. It's an example of a law regulation which could be followed by the management in the preparation of the financial statements. Okay. Now, say that same Indian company, say Infosys, it's also listed on the US stock exchange. This Indian company, it's also listed on the NASDAQ. It's listed on the US stock exchange. So now, to the US stock exchange authority, to the NASDAQ authorities also, will this Indian company have to submit their financial statements? Now to US Stock Exchange Authority, you cannot submit your Indian GAAP ka financial statements. To US Stock Exchange Authority, can you submit your Indian GAAP financial statements? No. So now this Indian company will have to prepare their financial statements, say as per the US GAAP or as per the IFRS, right? So again, this is an example of the applicable financial reporting framework, right? Applicable financial reporting framework. Okay, then say this Indian company, you know, this Indian company, same Indian company, it is a subsidiary. It is a subsidiary of a company which has a subsidiary of a company, and the holding company of this company is in Germany. And a holding company. So the India, there's a subsidiary of that company. Where is the holding company? Holding company is in Germany. Right? So now holding company in Germany will want the financial statements of their Indian subsidiary company. Your boss is sitting in Germany. And German company is the holding company. Indian company is the subsidiary company. Now this Indian subsidiary ka financial statements will have to be sent to the German holding company. Now, German holding company, again, you cannot send them the Ind AS financial statements. So, German holding company, you will have to send them, say, the German GAAP financial statements. So, see, if I have to submit my financial statements to the registrar of companies in India, I will have to submit my Indian GAAP financial statements. If I have to submit my financial statements to the NASDAQ authorities in US, then I'll have to submit the IFRS or US GAAP. If I have to submit my financial statements to the holding company and say my holding company is in Germany, then I'll have to prepare the financial statements as per management will have to prepare financial statements as per German GAAP. See, normal Indian company, normally, generally plain, they prepare financial statements as per Ind AS and Schedule 3. And normal. Normally, every Indian company won't get up and start preparing financial statements as per US GAAP or German GAAP. Those you are preparing for a specific purpose. Because you are listed on the US Stock Exchange, because your holding company is in Germany. Right? So sometimes company needs to also prepare multiple financial statements. Like, you know, Indian companies which are listed on the US Stock Exchange, they prepare the Indian GAAP financial statements and then they also prepare the US GAAP financial statements. And a two set of financial statements they prepare. Why? Because they have two AFR. They have two AFRF which is applicable. But generally, normal scenario kya hai? Ind AS and Schedule 3, or if AS is applicable, AS and Schedule 3. Does everybody understand the term applicable financial reporting framework? A very important term in audit. Hundreds and thousands of times this term is going to come. What is applicable financial reporting framework? It is the framework to be applied while doing the financial reporting. Framework mane what? It is the laws and regulations which are to be applied, which are to be followed by the management when they are doing the financial reporting. Financial reporting, that means when they are preparing the financial statements. And when they are preparing the financial statements. So auditor, what is your overall objective? To obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. So you've got that reasonable assurance. There is no material fraud and error. Once you get that assurance, what you will do? You will express an opinion saying, yeah, this management has prepared the financial statements in accordance with an AFRF. And to express that opinion, you will have to issue a report based on your findings. And this report has to be in accordance with the standards on auditing. Right, so what have we discussed over here, everyone? Please pay attention, sit straight. Essay 200, the overall objectives of the independent auditor and the conduct of an audit in accordance with the standards on auditing. Right, so what is the objective? To obtain reasonable assurance that financial statements are free from material misstatement, thereby enabling the auditor to express an opinion that financial statements have been prepared by the management in accordance with an AFRF. And then auditor, what you do? You report your findings. And how do you communicate your findings? In accordance with the standards on auditing. Right? So if I have to remember it in a short way, reasonable assurance free from material misstatement, prepared in accordance with AFRF, and then report the findings in accordance with the standards on auditing. So RFA, RFS. You understand, everyone? Reasonable assurance that financial statements are free from material misstatement, which allows you to express an opinion that yes, that financial statements have been prepared by the management in accordance with an applicable financial reporting framework. And then what you do? Once you've obtained that reasonable assurance and you say, yeah, they have been prepared in accordance with the AFRF, then you report your findings. How do you report it? As you wish? No. You report it in accordance with the standards on audit. Yes, everyone, are we good? Right, read this objective of the auditor. Yes, everyone, please read the objective of the auditor in essay 200. Right, one of the most important discussion in this chapter. Right, essay 200 overall objective is to obtain the, yes, did you, overall objectives of the independent auditor and the conduct of an audit in accordance with the standards. What is the overall objective? To obtain reasonable assurance about whether the financial statements as a whole, in totality, all items of financial statements put together are free from material misstatement, whether due to fraud or whether due to error, thereby enabling the auditor to express an opinion. What? Whether the financial statements are prepared in all material respects in accordance with an AFRF. And then to report on the financial statements and communicate as required by the essays. And how do you report? In accordance with the auditor's findings. Okay, finding means evidence. No, findings means if you find out any material fraud or error. Finding means if you find out any material fraud and error, then you cannot issue a clean report. And then you say, ma'am, not clean report, then dirty report. No, there's nothing called as dirty report. There's something called as a modified opinion. So clean is unmodified. That is clean report. Or you issue a modification. You say what? There is no, don't say they are free from material fraud error. This is the material fraud. This is the material error. So finding means fraud or error. That's the finding of your audit. Right? Clear, everyone? Okay, an overview of the objectives of audit and analysis of the above brings out the following points clearly. Auditor's objective is to obtain reasonable assurance whether the financial statements as a whole are free from material misstatement. Same thing, copy paste what is given in the objective of the standard, right? So same thing, right? Reasonable assurance is to be distinguished from absolute assurance. Absolute assurance is a complete assurance or it's a guarantee. Audit is not guarantee. Audit is warranty. In audit, you don't give guarantee. You give a warranty. And guarantee that financial statements are free from material misstatement. And reasonable assurance is not a complete guarantee. Although it is a high level of assurance, but it is not a complete assurance. It is not an absolute assurance. Audit of financial statements is carried out by the auditor in accordance with the skills and competence in accordance with the standards. Audit procedures are applied in accordance with the essays. Standards. You do the audit as per the standards on auditing. You obtain the audit evidence and evaluate. Based on that, conclusions are drawn, opinion is formed. It leads to a high level of assurance, which is called as reasonable assurance, but it is not an absolute assurance. Candidate for a specific question in your exam. Reasonable assurance is not an absolute assurance. Comment, 4 marks. This is the true reality of ICAI questions which you need to identify and address. Okay, can this particular, 3 paragraphs over here, can it be a separate question in my exam? Yes. Okay, reasonable assurance is not an absolute assurance. Comment and then you have to write down the points. Clear, everyone? Okay. Then misstatement, right? Misstatement in the financial statements can happen due to fraud or error or both. The auditor seeks to obtain a reasonable assurance about whether the financial statements are free from material misstatement, and is to see the effect of the misstatement in the totality. Because that's what we said, as a whole. And are the as a whole, did you see that? As a whole, are the financial statements free from material misstatement? Not individually, but you have to also consolidate, put it all together and check in whole whether the financial statements are free from material misstatement. And obtaining reasonable assurance that financial statements as a whole are free from material misstatement enables the auditor to express an opinion whether financial statements are prepared in accordance with an AFRF, right? So that's the second part of the sentence, enabling the auditor to express an opinion whether financial statements are prepared in accordance with the AFRF. And once that is done, then auditor, what you do, you issue a report and communicate your audit findings. And how do you communicate your findings? As you wish? No, as per the standards on audit. Yes, everyone, have you understood the overall objectives of the independent auditor? RFA, RFS. What does this mean? First R stands for OO, SA 200 OO, overall objective. R, to obtain reasonable assurance. What? That the financial statements are free from material misstatement, whether due to fraud or error, right? So reasonable assurance. Wonderful. Then free from material fraud and error, free from material misstatement, and then applicable financial reporting framework. And then auditor, what you do, you report your findings. How? In accordance with the, yes, as required by the standards on audit. Clear, everyone? Are we good with this discussion regarding the objective of audit? Right? The objective of the audit. Okay. Now we come to the discussion regarding the scope of audit. And now we come, right? So if I come to my list, which we are preparing over here, right? We are done with the objective of audit, in which we discussed SA 200. What is the overall objectives of the independent auditor? What did we say? RFA and then RFS. And RFA and then RFS. Now the next point that we shall be talking about over there is regarding the scope of audit. And the scope. What do you mean by scope? What do you mean by scope? Yes, everyone, tell me, what do you mean by scope? What it includes? Range, okay. Scope, okay. Applicability, okay. Scope means more or less I can consider it as what all will get, what all will be covered. Exactly. What all will be included, what all will be covered when the audit is being conducted, and then obviously what will not be included in the audit. Right? So as you said, what is going to be included and what is not included in the audit. Right? So obviously the scope of audit, we could know what is the scope of audit. Okay, what is included in the scope of audit? We do the audit of the financial statements. An audit of financial statements, balance sheet, profit and loss, cash flow statement, statement of changes in equity, and the notes for the year ended 31st March 2025. So that is my scope, to audit the financial statements of 24-25. That is the scope of the audit. Okay. And now, if I have to do the audit of financial statement, should management provide me all the information regarding all the items of the financial statements? All items of balance sheet, profit and loss, cash flow, SOC, notes. Should management give me the data? Only then I can do audit. No. If management say, no, see, we won't allow you to check our inventory register. Why did you see our inventory register? No checking. No, not allowed. Then will you be able to do the audit? Say, ma'am, yeah, I can do the entire audit, but then inventory, how I check? Not possible, no. So, is example I'm giving you, is inventory included in the scope of my audit? If I am doing a financial statement audit, is inventory included in the scope of my audit? Is inventory included? Is debtor included? Is property, plant, equipment included? Is sales included? Purchases included? Related party included? Yes. Everything which is related to the financial statements is included. But now what management is telling, CA, no checking inventory. Now what is management doing? What do I call this situation as? They're telling, no checking purchases, nahi, hath nahi lagane ka, nahi, no checking, non-cooperation. Oh my God, wonderful. Right. So now, my scope of audit is to check the entire financial statements. Inherent limitation. No, okay. Right. My scope of audit is to check the entire financial statements. Now they say, no checking inventory. So that means what are they doing? They are limiting my scope of audit. So there is a very important term which we have in audit called as limitation on scope. Limitation on scope. When do you have, you say that there is a limitation on scope in the audit? When management is telling you, or the data is only not available. Then you say, boss, if I have to check PP, I need the PP register. If I have to check equity, I need to check the equity, the shareholding pattern of the company. Data is not available, or it is available, but management says, no, we can't give you the data. So what are they doing in that case? They are imposing a limitation on scope. Right? So I hope you understand these two terms, scope and limitation on scope. Limitation on scope, we are going to talk more about it in chapter number 11. But I hope you understand the term. Limiting. They're restricting the scope of my audit. Restricting. Like I want to go on a particular route. I want to take a left, but there are barriers put over there. I can't take the left. I can't go. So my scope is limited. You understand? That is limitation on the scope of the audit, right? That's the limitation on the scope of the audit. Okay. So now for this scope of audit, what we have to discuss over here is what is included in the scope of audit. That is, what are the various points which should be included in the scope of audit. And second part of our discussion is regarding what is does not include, what is excluded from the scope of the audit. What is included in the scope of audit and what is not included in the scope of audit. Obviously, this chapter of nature, objective and scope of audit was there in the old syllabus, also called as Introduction to Auditing. But there has been a little bit of the revamp in the content. And one of the big revamp is over here, wherein they've now put a separate discussion regarding scope of audit, what it does not include. Right? So that also we mark it as a 5-star. That we mark it as an important question. So anyways, what is not included, that we shall come to it later. But now what is first we need to talk over here is what is included. So now scope of audit, we have to discuss the plus minus. Am I right? For scope of audit, we have to discuss the plus and minus. What is plus? What is included in the scope of audit? And what is minus? What is not included in the scope of audit. Right? So what is included and what is not included in the scope of audit, right? So first they explain the meaning of scope. What is scope? It's the range or reach of something, right? So general English meaning over there, right? Then what is the purpose of audit? Well, again, they go to the objective. Objective of audit is to enhance the degree of confidence of the users. To increase the confidence. We said we give an assurance, it increases the confidence of the intended users. Right? Confidence of the intended users. Who are the users? Quick answers. Who are the users? Kaun hai? Exactly. It's the gift to the shareholders and to the investors. But apart from that, they say employees also, because we said it's a moral check on the employees. They have the fear when they are doing the fraud, right? Then also customers, right? Government, regulatory authorities, bankers, etc. And enhancing the degree of confidence is achieved by expression of opinion. So auditor, you say, oh, I'll give you assurance, it will increase your confidence. How it will increase the confidence? When auditor expresses an opinion. What opinion he expresses? That financial statements are prepared in all material respects in accordance with the AFRF. So is it like a culmination of whatever we've studied so far? Purpose of audit is to enhance the degree of confidence users of financial statements may be, and then you have to express an opinion whether financial statements have been prepared by the management in accordance with the applicable financial reporting framework. Right? And then what is applicable financial reporting framework? We've already discussed that. It's a framework. Framework means what? It's a law and regulation which is adopted in the preparation and presentation of financial statements that is acceptable in view of the nature of entity and the objective of financial statement, and that is required by law regulation. Right? So we had a wonderful definition of the AFRF. What did we say? What is AFRF? It is the framework which is to be applied by the management, right? So it's the laws, regulations which is to be applied by the management while preparing the financial statements, right? While preparing the financial statements. Okay. And now coming to what is included in the scope of audit. So now we are talking about the plus points, right? So we are talking about the plus points. Right? So what is included in the scope of audit? It says it covers all aspects of the entity relevant to the financial statements being audited. So anything directly or indirectly related to the financial statements is included in the scope of audit. What does that mean? Okay, if I am doing the audit of financial statements, as a part of the audit, will I also check the salary expenditure, payroll? And as a part of the audit, will I also check the salary? Will I also check the payroll expenditure? Yes. So now if I have to check the salary expenditure, for that, will I check the salary register of the company? And the payroll register, the master file which they are keeping for the salary? Right? That is directly related in the financial statements. But when I'm checking salary, for checking salary expense, I will have to check the salary register. But will I also have to check the attendance register of the employees? Because based on their attendance, their paid, unpaid leave, based on that, the salary will be calculated? Yes. Yes, even that will be included in the scope of the audit. So to cover all aspects relevant to the financial statements being audited. You understand? All aspects. So will I check the salary register also? Yes. Will I check the attendance register also? Yes. Now, every day the employees are supposed to wear their particular uniform. The blue color uniform which is given to them. But they are not wearing that blue color uniform. They are coming in red, blue, red, green, orange color, purple color clothes to office. They're not using the uniform. They're using their own civil clothes and coming to office. Will that be covered in the scope of my audit? Attendance register, so it is directly affecting the salary. But employees are not wearing blue color uniform, but they are wearing the red color uniform. Will that be included in the scope of audit? No. Obviously no. That will not be covered. They say, what do I have to do? Is it directly or indirectly affecting financial statements, salary register, attendance register? Yes. But uniform, they are not wearing. Is it directly or indirectly affecting financial statements? No. Right? So all aspects related to the financial statements being audited is covered in the scope of the audit. Then what does it say? When I have to do the audit of the financial statements, for that I have to do the audit of the financial information. Rather, our definition of audit says audit is an independent examination of financial information of any entity. And this financial information, we want to check two things about this financial information. One is the sufficiency and second is the reliability of this financial information. And sufficiency and the reliability of the financial information. Right? Sufficiency and reliability. So I ask the company that, do you have any litigations going on? Any fighting going on? What they tell you? No, we are not fighter cocks. We are not fighting with anybody. Now this information which is being given to you by the management, which is related to the financial statements, don't you think it should be reliable? You understand? You are asking the company, are there any litigations going on? The peon of the company is telling you, no, we are not fighting with anybody. If the information you get from the peon, is that an authentic source of the information? Peon is telling, yeah, this company is not fighting with anybody. No, it has to be the CEO, the CFO, the accounts manager, the finance manager, the directors of the company, which need to tell you, okay, are you fighting or are you not fighting with anybody? So your information which you give to the auditor, it has to be authentic, it has to be reliable. And they give to the CA, okay, CA, take the list of our debtors. Is this list of debtor reliable? Whether I can rely on this data? Okay, and now I ask them, give me the list of debtors. They say, CA, take, this is the list of our debtors. But now the company has 1,000 debtors, but they gave me the data only of 200 debtors. So now is the information sufficient? No, it is not sufficient. Right? So data, the financial information, what we have to check is the sufficiency and the reliability. So sufficiency in simple language is where we are talking about the quantity of the information, and reliability is where we are talking about the quality. Quantity and quality. It does not give me lots of quantity, but quality it's not okay if it's not there, or very good quality but quantity not there. No, it has to be quantity and quality, both need to be correct. So anyways, I think I'll be coming across this term many times, so let me anyways pick up this term, audit evidence. We've already said this evidence is nothing but information. And how this information should be, which is obtained by the auditor, it says it should be sufficient and reliable, but there is a broader term for reliable, which is called as appropriate. SA. We'll keep on coming across this term called as SAAE. What is SAAE, everyone? It means sufficient, appropriate audit evidence. Sufficient, appropriate audit evidence. Okay, again, the terms which I discussed with you today: free from material misstatement, applicable financial reporting framework. Now I'm discussing with you SAAE. These are like the lifeline. These are like the underlying nerves of the subject of audit. Okay, so now say, let's, for example, no Blinkit, no Swiggy, right? No milk basket, country delight. We go to a vegetable market. Can you visualize in front of your eyes the vegetable market, everyone? Do you go? Have you ever been? All the vegetable hawkers are sitting over there. Winter time, such a wonderful time, no, for vegetables. And you see so much of carrots and green peas and so many fruits and all fresh, spinach and what you say, fenugreek leaves, methi and all, so much of it. Okay, so say probably today we've come to the vegetable market with an intention to buy 2 kg good quality carrots. And say gajar ka halwa is to be made, and for that 2 kg good quality carrots is what we want. So what we do, now we go to the market, we have a cloth bag with us, and then we want to buy the 2 kg of the good quality carrots. So now, generally one, so you have a fixed vendor to whom you go and you purchase and you come back. Or another, every time you can take it from, different fellows. Sometimes some person has something good or so. So what we do, first we do a walkthrough in the market. And we take a round and we keep on seeing on the left side, right side, who is having, what is there today. Sometimes even if you don't want it, you've not thought about it. But when you see it over there, it comes to your mind, oh, let me take this. Whatever you find good. So anyways, you're walking in the market, you're asking those fellows over there, okay, how much? So one fellow says 50 rupees kg, another says 60 rupees, some fellow says 40. So all 40, 50, 60 range. So what you do, you walk around the entire market. You never buy at the first or second shop, because if you buy there, then you go ahead, then you realize, oh, why did I already buy? It was better ahead. So what you do, first you do a walkthrough. Then on your way, reverse back. So it's anyways, easy to carry, walk without the burden in the bag, and then while coming you just start buying whatever you want. Okay, so now you start buying, and then you wait at this one fellow and then you tell him, give me 2 kg carrots. Okay, so now it's an old vegetable market, so they have that weighing balance, weighing balance, taraju. Okay, and in that weighing balance, what they do on one side, now they'll put the 2 kg ka measure scale over there, right? Measure scale over there, and on the other hand they will tell you that now you give the carrots to be put over there. So generally they give you a basket and they say you select whatever carrots you want, and then you start selecting the carrots and put it in the basket over there, and then whatever you put in that basket, that fellow is putting it in the weighing scale, and then now you are selecting, no, but it takes time. But in that, what that fellow does, one or two big ones or not very good ones, he puts it on his own. So you tell them, bhaiya wo jo aapne dala wo nikalo, what you put, remove that, that's not good. Okay, so then that is removed, then you again put something, and then after that he says done 2 kg 2 ho gaya. They say no, not that, more 2 will fit, and more 2 can be accommodated. And then after that, say the 2 kg carrots is done, you give your cloth back, he puts the carrot into that, say it is 50 rupees kg, so you give him 100 rupees, and you are like about to leave from there. And so 2 kg good quality carrots for 100 rupees, that is what we have, right? For 100 rupees, right? That is what we have purchased. Okay, let me check for the internet. Yeah, it's there. Right, 2 kg good quality carrots is what we have purchased. Okay, but now this fellow says, okay, that because you're a regular customer or so, or just he has very good marketing skills or so, he says what you can do now, instead of 2 kg, I will give you 3 kg. And a price same, 100 rupees, but instead of 2 kg, I give you 3 kg, but this quality is not that good, so quality wise it is little low. Okay, right. So then the fellow says that instead of 2 kg, I give you the 3 kg, but quality wise it is little low. Okay, so you say no. You giving me more quantity cannot compensate for the quality. So 2 kg is the quantity and quality is good. So you say no. Quantity cannot compensate for the quantity cannot compensate for the quality. Okay, then this offer is rejected. Then the fellow says, okay, no problem. Instead of 2 kg, what you do, you take 1.5 kg. But 1.5 kg price same, 100 rupees. But now what we do, we give you imported quality, more superior quality. What is the definition of imported in Indian vegetable market? Is where a sticker has been put. Right, so yeah, in between the lecture, but I have started the connection just and then I did not say anything during the time the connection was lost. Okay, right. So then instead of the 2 kg, give you 1.5 kg, but imported, superior quality, the sticker has been put. Then what do you say? No. Quality cannot compensate for the quantity. So one we said quantity cannot compensate for quality. Then we say quality cannot compensate for quantity. Then the fellow says, okay, you want 2 kg, no? So what you do, 1 kg you take the carrot and 1 kg you take the green peas. Why? Because green peas has also come very good now. And a price same, 100 rupees. Now you say what is to be made at home is the gajar ka halwa. You giving me the green peas is not relevant only when we have to make the carrot halwa. You understand that, right? So now over here what we are saying, quantity and quality. Quantity cannot compensate for quality. Quality cannot compensate for quantity. And some other vegetable cannot compensate for the vegetable which we want. Okay, like say example, in a company, I'm telling you, say in a company, we want to check the addition to PPE. And addition to property plant equipment. Say company has purchased a new computer, laptop. So we want to check the addition to the PPE. So now, how do you check the addition to PPE? One, you need to check the asset requisition note and whether that has been prepared and authorized. Okay, we need to purchase a new laptop for the company. Okay, once that is prepared, then whether the quotations have been received from the vendors, your authorized vendor. Then once the quotations have been received, the best quotation, whether the PO, the purchase order, has been raised. Once the PO has been raised, whether the goods have been received. So asset inward note. Now, after the asset inward note is prepared, obviously they will also do the quality inspection. That should not happen that we ordered for a HP laptop and some Asus or some Lenovo laptop has come. Right? So quality inspection note. And then after the asset inspection and quality inspection notice prepared, now this purchase, it will go to the purchase invoice. Along with that, now it will go to the accounts department for the accounting entry. So these are all the supporting. The voucher and support to the accounting entry. And then after that, the depreciation will be charged from the date the asset is ready to use. And then after that, also the payment will be made to the vendor on the due date. And then after that, also the Schedule 3 disclosures in a generally accepted accounting principles need to be followed. Okay, now say during the year, the company has made 1,000 purchases. Example, 1,000 additions to PPE. Obviously, I am not going to check all the 1,000 additions to PPE. I will select a sample. So see, my sample size has come to 20. 20 additions I want to check. 20 addition out of the 1,000 additions that they have done. I want to check for these 20 samples. That's the quantity. And quality is what? These 10 supportings. Now 10 is not actually the number over there. It's actually these 10 points which I want to write. And okay, I want to check the asset requisition note, the quotation, purchase order, and all of that. So these are the 10 points which you want to check for each of those 20 samples. Okay, हर एक sample के लिए you want to check for these 10 points. Then you will say that quality is good. So client, for the 20 samples addition to PPE, if they, for each one of them, if they give me the 10, 10, 10, 10 points, the 10, 10 points which I want to check for, then I will say yes, yes. Quantity also good and quality also good. Now, client starts, what you say, negotiating with me. That CA, what you do now, instead of 20 addition to PPE, you check 30. But we won't be able to give you 10 supportings for each of them. Sometimes we'll give you 6, sometimes 7 supportings. That much we can give. What CA will say? No, no. Quantity cannot compensate for quality. Then client says, CA, you want to check 20. Instead of 20, you just check 8. But for these 8, we will give you 15, 15 supportings. And we will give you 15, 15 supporting documents. What CA says? No, no. Quality cannot compensate for quantity. And then client says, CA, you want to check 20, na? So what you do? 10, you check PPE and 10, you check inventory. And how is inventory relevant when I want to check the PPE of the company? Inventory, I will check, but that I will check separately, na? That is not relevant when I have to check the PPE of the company. You understand? So, whenever auditor, you have to obtain the audit evidence. How the evidence should be? It should be sufficient, sufficiency, and appropriate. That is appropriateness of the audit evidence. Sufficiency refers to the quantity. Appropriateness refers to the quality, and quality means two things. One, it should be relevant, and second, it should be reliable. And it is sufficient and appropriate audit evidence. It is not sufficient or appropriate. Why it is not sufficient or appropriate? Because quantity cannot compensate for quality, quality cannot compensate for quantity, and some other evidence cannot compensate for the evidence which I want right now. So everybody, do you understand the term SAAE? ऑडिट एविडेंस सफिशिएंट एंड, है ना, क्वांटिटी भी बराबर होना चाहिए, क्वालिटी भी बराबर होना चाहिए. इट कैन नॉट बी टेक मोर क्वांटिटी लेस क्वालिटी और मोर क्वालिटी लेस क्वांटिटी. इट हैज टू बी सफिशिएंट and appropriate. Like old and earlier times, no, they say, ma'am, today also, okay, they say, no, कि लड़की कैसी होनी चाहिए, लड़का तो don't know, but yeah, you might have heard that, no? Those who are having some knowledge of Hindi, you might have heard it. You say, ma'am, no. सुंदर और सुशील, है ना, सुंदर और सुशील, सिर्फ सुंदर, no, 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 सिर्फ सुशील, no, 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 beauty and brain, and both have to go together. So don't write an exam just as how the girl should be, what do you say, beauty and brain together. Similarly, evidence should also be sufficient and appropriate quantity and quality put together. No, but separately, if we understand how evidence should be sufficient and appropriate audit evidence. Okay, right? So time for us to take a break and then we shall continue, right? So 10-minute break and then we start again. Okay.